from the interest rates? So how does it make money from interest rates? Where does the money come from? Positive. Okay, so how much do we pay on our deposits relative to our loans? How much do we pay on our deposits relative to what we charge for our loans? Less. A lot less. Yes, if you've got a savings account and checked out the pathetic rate that it is today, it's pretty low. So how does a bank make profit? The way they make the majority of their money is through loaning out money, loaning out funds at rates higher than what it pays deposits. That's the game they play. Now it turns out there's little other ways that they can make money, but this is their primary bread and butter. So for example, if they have $100,000 in deposits, paying 1%, and loans of 100,000 at 6%. So they play this spread game, right? The spread is equal to 6% minus 1%. So maybe they're making a 5% spread. Is all of that profit? So on the books, they've got loans at 100,000, 6%, 100,000 deposits at 1%. They got a 5% spread. All of that just pure profit. So what are some things that it needs to take into account? Okay, so the amount of people, did you say withdraw the deposits? I mean, is that what you meant?
If we bail out, if they can't pay back.
If they can't pay, yeah. So we have a default risk, right? So some of this 100,000 might not pay off. So we've got default risk on the loans. What else?
Some of these loans could be open loans that might not be at full capacity.
Okay. So we have loans with varying maturity. And people might pay off their loans. Is that what you were getting at? That they might pay off their loans?
If someone has like a $20,000 open loan, but at that time they only got $5,000 on the out.
Oh, kind of a line of credit type of thing?
Yeah.
Okay. Yeah, yeah, so that adds potentially some volatility of not knowing how much there is, right? So loans with varying maturity, you might have, line of credit loans where they've got a 20K limit, for example, but only 5K loaned out. So there might be some variability in the amount of loans that are out at a given time. Okay. Yes?
Maybe maybe if there's anything in the market where people are going to start withdrawing their money, like their savings,
Right.
They'll have enough money.
So part of the risk of losing the deposits, right? So that's a possible exposure. So maybe there's a unknown or uncertainty, unknown withdrawals, which kind of makes it hard to balance if some of our deposits disappear on us. All right, anything else come to mind? What else is needing to be paid for out of the spread? Overhead, yeah. So there's overhead costs, usually fixed costs, if we go back to class, of the rent, manager salaries, copy machines, paper, you name it. All the supplies of running the bank, right? All kinds of overhead costs. Okay, so that's kind of our game that they're playing. Any other last comments or questions there? So keep that in mind. That's the overall of what we're trying to do. I'm going to do a little PowerPoint action today to change things up. All right, so on the balance sheet, right? Assets, so here we're kind of talking about flows of income and expenses. So more of an income statement is the thing I said on how you make profit. Balance sheet, we got reserves, cash items in process, deposits at other banks, securities, loans, other assets. What are the main liabilities of the bank? What is a liability to the bank? First of all, for the people who haven't had as much accounting as others, it's been a long time, what's a liability? In general, I'm not going to hold you to it. I'm not sure I can come up with a perfect definition. But something that causes risk to your business. No, it's not so much on the risk part. That would be an example of a liability, right? So what's the nature of debt that makes it a liability? Anything you owe. So it's kind of something that's counting against you, right? So what is counting against the bank? Accounts receivable. Now, if they got money coming in, wouldn't that be on the asset side? If they have, if you're running a business and you have accounts receivable, somebody owes you money, right? So wouldn't accounts receivable be on the asset side? Right, there's risk associated with it, but at a point in time, it's on your books as an asset. So accounts payable, so money that you owe. Who do you owe the most money to? You're running a bank now.
Other bank?
Not so much the other bank, Alex.
Government, or like that.
That's not the biggest person, but yeah, you might owe the money to some government, possibly, or have something on the books there.
People who actually.
Yeah, the account holders. That's your liability. That's their money, not yours, right? So that's what's kind of weird about banking, because we usually think of our accounts being our assets, which they are. So on our personal balance sheet, my checking account is an asset, as long as it doesn't have a negative number in it. But if my banking account balance has a positive number, it's an asset to Russ McCullough. If I have it over at People's Bank, it's their liability, right? So that kind of, whoops, this is not the right figure. See, I got this thing started. Recording now. So that is our big liability. And then some of the other things that you mentioned as well. They have bank capital listed on liabilities. What's bank capital? There's some of my accounting people I can pick on. Chisholm's got a smirk on her face. Logan just smirked. Bank capital. No, but that's a good guess, especially for an econ student. So he has not had the upper levels of accounting, the same as, but you're right, that's the perfect econ answer. It is machines and buildings and stuff like that. But for accounting class, what is it? Yeah, they're paid in capital, that's right. So whose money is it? Whoever started it. It's the owners. It's the owner's equity. So it's their money into the business. So when they started the bank, there was 10 people, and each one chipped in $1 million. Capitalized the bank with $10 million worth of their owner's funds. What did they do with that money? Maybe they went and bought a building, they got started, and so some of it was startup money, right? That then filters its way into other assets. So if they bought their building, they had $10 million worth of capital, everything else was zero. Boom, we're starting today. Okay, let's go buy a building for $1 million. So we buy $1 million building, and now I have an asset of $1 million building, and I've got bank capital of 9, right? And I start doing my debits and credits to figure out what the balance sheet looks like. So in other kind of beginning accounting classes, we've got owner's equity, right? So what do we know about the equation of assets, liabilities, and owner's equity? They got to be equal to each other. So assets equal liabilities, and in this case, they're throwing the bank capital under the liability side, which is still technically right. End of the day, assets equal liabilities, or assets equal liabilities plus owner's equity, the money that they have. Okay, any questions there? Oops, wrong blue clicker. All right, so here is the balance sheet of the average bank. Of all, they put on here all commercial banks in the United States as of June 2014. And so they looked at all the banks, and all these numbers represent averages. They've expressed them as a percentage, right? So everything's been kind of normalized into 100%. So you can think of this as a $100 million bank with $100 million of assets. The average bank looks like this. They've got 19 million in reserves, 13 million in U.S. government securities, loans in the form of commercial banks, real estate, consumer, interbank, other ones. So here's their loans, their bread and butter. Where does that come from? Comes from our deposits, checkable deposits of 11 million, let's say, if that's 100 million again. Non-transaction deposits, so small denomination time deposits, less than 100,000. Those are the certificates of depression that we talked about, the CDs, certificates of deposit. Savings deposits, 47 million. Large denomination, greater than 100,000, 11 million. Borrowing, so you can see if you add these three numbers up here, we've got 2269 million. Of our liabilities, 69% is wrapped up in deposits. All right. Questions on that chart?
Your banking was get started off with like
I was just making up a number. I think you can get a bank started with even less than that. And so part of the amount of money that you need to, you first of all have to be passed through starting a bank and get it chartered is the initial process. But yeah, that wouldn't be unusual to start a bank with 10 million. And the banks that I was familiar with, a lot of them started off with a small pool of investors and asked for usually minimum contribution was $100,000 to be an owner of the bank, or at least a co-owner. So I saw a little bit of that in my real estate days. Okay, any other questions here? U.S. government and agency, 13. What's going on there? U.S. government and agency, 13 million of our fictitious $100 million bank. Bonds, good. So treasury bills. So the bank, if they're over here, that's an asset. So they owe the government money, or they loaned Obama some money. They loaned Obama some money, right? So they went to Wall Street and purchased one of these suckers, right? So now the bank owns the bond, and it shows up on their balance sheet right here. So that's a little bit of their asset mix. All right, anything else there? All right. So here's the bank basics. Checking account. Debit and credit action. Professor Wagner will be proud of us today. I really can't see him. So. We'll get through. Don't tell her that part. Well, sure. But so bulk cash. What do we mean by that? Money in the bank vault. Literally? Is that what that means? Tag says no. Who agrees with tag? It is literally bulk cash. It is, you're right. It's money in the bank, so to speak, in the vault. So it is cash on hand. It is literally cash on hand. So what we're kind of walking through here is that McCullough comes in with $100 and says, I want to put this into my checking account. Boom. I go to the teller window. All of a sudden, bank's money went up. So bulk cash is literally money in their vault, also in the teller's drawers. Right, so that would be bulk cash too. So it's money that's out there that the bank has on hand. They keep track of all that, as you can imagine. All right, so now I took on a liability of a checking account deposit to McCullough, and I have cash. That cash then becomes what we call reserves for the bank. So there's an increase in reserves. Guess what they can do with reserves? They can loan them. So that's our start of our process here of getting into the bank loan process. So we just got these two snapshots to say the bulk cash is part of our reserves. It's our first step in the lending process. All right. So there's money kind of in between. So if you go, if Kurt cuts me a check from his bank and I run to my bank and put it in, there's a little bit of a delay of getting the banks reconciled between each other. And so once it comes in, there's items in process and we get the checkable deposit. So McCullough's account was credited for the Kurt deposit with a piece of paper, but it's in this kind of in process stage. And then once the two clears, the Federal Reserve does this process, by the way. The Fed clears it, reserves leave Kurt's bank, and McCullough's bank is credited with the reserves. All right, and then the checkable deposits, of course, adjust as well. Questions there? Kind of going in slow motion here. It's going to pick up. All right. So where do we make our money? We make it with loans. So of the reserves, what's going on over here? I got this required reserves and excess reserves. Who remembers that from this is review from macro now?
The Fed requires them to do a percentage.
Right. Actually, you just reminded me of something. Thank you. No, this is for class purposes. If it rings, though, and actually, did I shut this thing off? I did. That's good. We have a potential opportunity for you to visit the Federal Reserve. Dr. Moore and I are collaborating on a student trip, and We're going to skip class for it. So if you go, you get full credit. If you don't go, which is your choice, then you get to write a short little paper on the Federal Reserve, which will be fun too, because we're going to learn. One of the things we got, how did we do this here? Oh, you know what? It's not till November, so I just wanted something for you guys to have, look forward to and hope. Yes. Money banking. Fed tour, there it is, November 2nd. Wednesday, November 2nd, if you want to jot down in your notes. Wednesday, November 2nd, and it's going to be in the afternoon. And we have a Federal Reserve I think it's one of the economists that they have is going to come speak to us special before we tour too. So you guys will get to talk to somebody who's actually working the numbers at the Federal Reserve. So that's down the road a little ways, but this made me think of this. So as Teddy mentioned here, the government requires the banker to hold back some money that can't be loaned out, right? So that's the required reserves. That money cannot be loaned out. Excess reserves can be. So excess reserves is the money that can be loaned out. So First National Bank here can change that portfolio to a loan that went out the window, but they're still going to have to keep 10 million on reserve.
Is that a different percentage for just different banks? Or is that all together?
So in this class, when we're going through this, we'll usually just treat it as all banks have to hold X percent. But in reality, if your bank has been in trouble or you're a little undercapitalized or something, you might be required to hold back some. So otherwise, they have kind of a sliding schedule of how much money to be held in reserves. Yes?
Yeah, like different banks, or like First National, like
yeah.
Obviously, just individual location, or like.
It's for the whole bank overall. I think there's maybe a couple ways that they can set it up, but that is, so like Wells Fargo has a zillion locations everywhere. They look at Wells Fargo in aggregate, yeah, because to meet the reserve requirement at any one particular bank, they can always just electronic transfer. So it's all internal anyway. So it's treated as internal. I think there might be a way for them to set up a separate charter so that the bank runs itself. And some banks did this, especially prior to the financial crisis. They were expanding, and they're like, I don't want to commingle the bank activities. I want the Ottawa Bank and the Lower Bank to kind of do their own thing. And so it is possible to set up so that they're, with the Fed even, so that their operations are not intermingled. Okay, any other questions? All right, so what does this mean? The bank borrows short and lends long. Yeah, what does it mean by short? What are you thinking? Short term, what does it mean on the borrowing short? I think you're saying the right thing, but you're mumbling so little I can't hear it.
Like they're borrowing short.
Okay, they're borrowing short term, right. In the form of what? What's their borrowing? Yeah, no, not T-bills. Now that's not where they're borrowing from the depositors, right? And so can that depositor go and get their money anytime they want? Yeah, so that's a pretty short loan, right? So they're kind of playing that game. They're borrowing on a very short term, but then they're sending money out the door if they're on a car loan, 5 years, mortgage, 15 to 30 years potentially, right? Commercial lending for a business that wants to have some line of credit or something. That might be 3 years in nature or something. So they're always lending out money in a longer term position than what they're borrowing at with the deposits, because it's not even really borrowing in a sense, with that liability being deposited. Okay, good. Any questions, comments there? So here are the things we're going to look at as we manage the bank. Liquidity, our assets, our liabilities, things that we've actually touched on already. management meaning deposit management, right? That was our main liability. Our asset management, our loan portfolio, we got to think about the loan side. Liquidity, the terms of each one. Capital adequacy, how much the bank has in. Credit risk and interest rate risk. Because if we're lending long at 6% and we're borrowing short at 1%, if rates go up on deposits, if market rates go up to 2%, I don't have time to necessarily change my long-term lending portfolio, right? So there's a bit of long-term planning and strategizing to think about the terms and durations and risks associated with them. All right, so we're going to take each one of these individually. So suppose that the Federal Reserve requires 10% be held back. If a bank has ample reserves, a deposit outflow does not necessitate changes in other parts of its balance sheet. So check it out here. Assets equal liabilities is usually a good thing to check. True or false with this bank? Assets equal liabilities? Good, right? 110, 110. And this bank over here, 100 million, 100 million. So they're balanced, right? That this is an okay way to hold the bank. So what happens if they lose some securities? So what happened between these two? If we move from this being our bank to this, what changed on us? I'm not thinking these are different banks. This is the same bank. Yeah, people withdrew their deposits. Okay, so how did we handle that? Reserves. And did we have enough to meet the minimum still? Yes. So this is saying, because of my bank policy, did I loan out everything I could have? No, because I had 100 million. I only had to have 10 million in reserves here. I've got 20. And so if I was facing a risk of a run on the bank of people sucking their deposits out, I was able to ride that out and not be put in jeopardy here because I'm still meeting my reserve requirement because I only need 9 million and I've got 10. Okay? All right, so that's one situation. Cool on that? Any questions? What happens with a shortfall? What needs to happen here? Covered by the government? No, not necessarily. It could be. There might be some things we can do. How can we get back into good graces with the government, I guess is what I want to. So the government could be involved, I guess. So what you said isn't necessarily wrong, but it's not just going to be automatically covered, like the government somehow automatically does something. The bank has to take some action here. Joe?
I was going to say something.
Okay, so the securities that are sitting here, are those marketable securities? Are they marketable securities? Yes, I can go to Wall Street today and sell those, right? We just got out of the chapter with the very active bond market. And so if those are sitting with US government bonds, or even if there's some corporate bonds, or maybe even junk bonds in there, I can unload those today. If I call my broker up and I say, sell, 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 how much you want to sell? 9 million. How does the balance sheet change? Good, yeah. It's just going to adjust, right? So we're going to take this asset, it's going to bump up here. That makes us good with the government at the 10% level. Otherwise, nothing else changed. How else can I fix my balance sheet problem? That's one possibility. Calling some of the loans. Possible? Yeah. I call up my people that I got money out to and say, hey, sorry, you didn't read the fine print when you signed all that massive wad of documents I did, but I had the ability to call your loan today. So bring in my $9 million. So this changes to what? 81. And reserves go up to 9. I'm back in good graces with the government. What else could we do?
Borrow.
Borrow. Good. Where are you going to borrow from? Another bank. How would that change the balance sheet? I borrow from another bank. Okay, so liabilities picks up a new line item called bank borrowing or loan from JP Morgan Chase of $9 million. Okay, then what else? We got $9 million in reserve. So now I have a loan on the books of $9 million from JP Morgan Chase, and JP Morgan Chase actually gave me cash, and so now I'm back to good graces. How else could we fix the problem? What's that? Withdrawal capital, yeah. So if we have capital here, we can call the owners and ask them for more, is one thing we can do. Or we can maybe borrow it from ourselves if there's enough capital here. So this is what gets into a kind of a different scenario. The Federal Reserve doesn't let you get too small with this. You have to be well capitalized, and so you can't just change that into a loan to ourselves and make it good. But that's the concept. You could, and then the other way tougher is to call up your owners and say, hey man, remember when you invested in this bank 5 years ago and y'all put in 100,000? Well, we need 9 million. So you own a tenth of this bank, take 9 million divided by 10 and write me a check, right? So the owners could bring more capital to the table. So you can see we got lots of sources to be able to go to. We can sell some securities, call in some loans, call up the owners, and then borrow from another bank. So we got different ways to kind of fix this problem. But what's for sure is your bank's going to be closed by the Federal Reserve. You're going to lose your charter if you don't fix the situation, because that's why they call them required reserves, the amount of reserves. All right, so here's some of what we just talked about. So here's the old situation. Here's one possibility, borrowing the 9 million. Then we get it back in there, and where it's going to cost us, this is off balance sheet, this is more of an income statement thing, right? I owe money to the person I borrow from. So when we look back to our expenses and of running our business, that's going to run up, that's going to be added to the income statement. We're not going to make as much money this year. All right, questions on that one? Yeah.
Not necessarily on that, but like, why would banks buy other banks now? Like, are they necessarily doing bad, or are they...
Well, and that's kind of a loaded question. So why do they buy each other out?
Yeah, like say there's a credit union and it's a certain name,
Yeah.
and the next thing you know, it's changing its name.
Yeah, yeah. So that's happened a lot. If they want to expand their business, one way is to start a new bank. Another way is to buy another existing bank. Typically, an existing bank, you can probably buy cheaper than starting your own. And so they just make an offer, and it's just like buying another business. But then what happens is if they buy another bank and essentially merge banks, we lose the number of banks. So the amount of banks goes down, competition goes down. Just like we have with corporate mergers, the latest one being, that's been in the news here, the Bayer and Monsanto deal. That's a huge one. Those both monster global companies. And the jury's still out as to whether they're going to allow that purchase to go on. Okay, so same thing going on in the banking industry. All right, so what do we do here to fix? Sold the securities, so this was the securities option. You're going to run into some brokerage costs, right? They might have a little commission for selling the securities. So those are the types of expenses we might run into there. Borrowing from the Fed. So one option is to borrow from JP Morgan Chase. The other one is to go to the Federal Reserve. There is a borrowing facility called the discount window, so they can borrow from the Fed. That was, I guess, the first thing brought up by Matt, is to get maybe the loan from the Fed. It is a loan, there is interest. So that's an option. And then finally, our situation of going to the loans. Why is that the most costly way?
You don't get as much interest back.
Yeah, you don't get as much interest, right? So yeah, from a long-term perspective, you have this lost interest of the loan they were paying the 6% in the little example I started off with. So we're calling in those. So costly in terms of lost opportunities. What else? What other sorts of costs or problems might you run into? Somebody else?
Have the money at that time to pay off loans. They're calling in.
The borrower, you mean? The borrower doesn't have the money, yeah. And so are they very happy when they get that call? No. Are they going to do business with your bank in the future? Are they going to tell their friends about how much you suck? Yes, right? So that's the real cost associated with calling in loans is reputation matters, and it's probably going to have some long-term implications. All right, but it's a possibility. And of course, depending on the situation, the bank can do all combinations with that. So 3 goals with asset management: seek the highest possible returns on loans, reduce risk, have adequate liquidity. Sounds like 3 noble goals. Why is it difficult for all banks to meet all those goals all the time? Seek the highest possible return on loans and securities, reduce risk, and have adequate liquidity. Yeah, they kind of contradict, right? So there's trade-offs with each one. If we go for higher returns, what do higher returns usually come with? More risk. So those are right competing with each other. So we might be better saying seek the highest possible returns for a given taste of risk or a given level of risk. You know, that you're always seeking for those higher returns. Reduce risk, where on the deposit side, we kind of look all over. Have adequate liquidity. Why is that maybe contradictory to some of this? What does it mean to have adequate liquidity? Money on hand, potentially, right? That'd be the most liquid thing if we have lots of cash on hand. And why is that contradictory to number 1 or number 2? Okay, longer loans, less risk. Longer loans, less risk? But it's good to think about that, but usually longer loans, longer amount of time for people to default on you. So usually we have a little more risk with that.
Their highest return comes from loans.
Okay.
You have all your money out in the loan market, but you're not going to have as much adequate.
Good. It's completely contradictory, right? So the amount of money that you can loan out is the full amount of your excess reserves. But it might not be the smart thing to have every penny that the Federal Reserve would allow you to have out. You might not be maintaining an adequate liquidity from a business standpoint of like being able to manage your portfolio. But at the same time, if the money is not out on loans, then you're not doing number 1. So that's a balancing act, having enough cash available to be satisfied there, as well as seeking those returns and reducing risk. So, 4 tools. Find borrowers who will pay high interest rates and have low possibility of defaulting. Well, that sounds like a great idea. Purchase securities with high returns and low risk. Wow. this is easy. Why do people think banking so hard? Lower risk by diversifying. And we didn't really talk about diversification so far. What's diversification? Personal finance people. Spreading your money out, not put all your eggs in one basket, have different types of loans. So I don't have all car loans. Because if car loans is the only thing I do, I might be taking on more risk as opposed to having some other types of loans on my books. So it'll actually lower risk, because if the car market goes in the crapper, my bank goes in the crapper, along with the car market. But if I have cars, home loans, credit cards, some other things, then if cars go in the crapper, I've only lost a fraction of my business. I'm still hopefully strong in some other areas. Balance the need for liquidity against the increased returns from less liquid assets. So, number one, how can we do it? Sounds easy. Find borrowers who will pay high interest rates and have little possibility of defaulting. Okay, so we might have something with new credit scores. So we might use credit scoring as a tool to help us farm for people. What else could we do? Think about our business model again. That was what we started off with. How do we do it? What do banks do? Think about your hometown bank, or maybe where you guys bank. What are some of the things that they do to try to make money ultimately?
Maybe like a credit card.
Okay. And how so? What are you thinking there?
I mean, if the price goes up, they owe more off than what they've already spent. I mean, I guess it's kind of
so
the same thing as a loan.
Yeah, and that's okay. So let's assume that the bank's already engaged in that activity. They've got credit cards, car loans. They have every type of loan. Every type of consumer loan this bank does. What can they do to satisfy number one? Find borrowers who are willing to pay high interest rates and have low possibility of defaulting. Credit score is one possibility. They could farm credit scores to find good people.
Co-signers, if you want.
Co-signers, maybe. Start requiring, changing policies for that. What other things can be done? How do they find these people? And that's why I want to think about some of your hometown banks. They're usually better at this than others, although even Wells Fargo and JP Morgan Chase try to do this too.
Get more customers.
Yeah, what do they do for customers? How do they get those more customers? What do they do in your community? Offer free crap. That's one way. Give away a toaster, maybe, right? What else do they do to work on relationships?
One of them offers like $100 to start with a direct deposit.
Okay. So give you a little bit of money, give you a toaster, give you a phone call maybe. Hi, I saw that you just opened up an account with us, and I just want to let you know that we have a full portfolio of products at our bank. We're a full service bank, so if you have other investment needs, you have John in investments, and he can help you with your retirement funds. We've got Susie, who helps with managing loans. If you have kids that are in need of loans, we've got special co-signing arrangements, right? That's how you start to develop a relationship. So they spend a lot of time trying to customize their product in hopes that they can develop trust with you is one thing, so that you pay your bills back, but also so that they can get more of their product out the door. So that's an important play in it. All right, purchase securities with high returns and low risk. What do they need to, what does a person need to do that? And I'm being serious. Let's say they want to increase their holdings of securities. What do they need to do? What sort of activities do they need to take on to do that successfully? Might want to give a call to John. I named him John just moments ago, right? What does John do? He does investments. He looks at Wall Street. He does charts. He does balances. He listens to the news, right? So basically, develop a relationship with a broker that you trust or know, or do it internally. Bigger banks do it internally. They're to look for different investments themselves and not rely on a third-party outsider to do it for them. So that's an activity that takes some time and is not just a trivial task. Again, we talked about diversification and liquidity against increased returns from less liquid assets. There has to be some communication on risk associated with that. That's probably a little bit of a research activity as well as the boardroom activity. All right, we'll stop there for today.